The Psychology of Investing. Chapter 8. The Role of Habit in Investing. Many people know they should invest, but the problem usually is not information. It is behavior. Every payday, saving has to compete with immediate wants, small conveniences, and the feeling that there will always be another chance to start later. Those tiny decisions may seem harmless one at a time, but over months and years, they shape the outcome. Automation matters because it removes that repeated save or spend debate from the process. Instead of depending on discipline in the moment, it turns investing into something that simply happens as part of your routine. An automatic savings plan is simple. Money moves on a schedule without requiring a fresh decision each time. You choose an amount, choose a date, and set the transfer to happen regularly, often right after payday. That transfer might go through your bank, your employer retirement plan, or directly into a brokerage account. The real advantage is not complexity, but consistency. When the money is moved before you casually absorb it into spending, investing stops being an occasional good intention and starts becoming part of your financial system. This is the idea behind paying yourself first. Instead of hoping there is something left at the end of the month, you treat saving like a real priority in the budget. Bills get paid, life continues, but your future also gets its share automatically. That small shift matters because leftover saving is usually irregular, while planned saving is repeatable. Over time, this creates a different identity as well. You become someone who saves first, not someone who saves only when conditions feel perfect. That steady pattern is much more powerful than occasional bursts of motivation. Automatic investing also helps solve a common mental trap: waiting for the right time. In real life, the right time never feels obvious, because markets can always seem too high, too unstable, or too uncertain. A fixed contribution schedule keeps you participating through both good markets and bad ones. That supports dollar cost averaging, where the same amount buys fewer shares at higher prices and more shares when prices fall. You're not trying to predict short-term moves. You are building a habit of showing up consistently. For most long-term investors, that discipline matters more than making perfect guesses. Habits are easier to maintain when they have less friction. If saving requires you to remember a date, log in, choose an amount, and talk yourself into it all over again, there are many chances for the process to break. Automation shortens that path dramatically. The fewer steps between intention and action, the more likely follow-through becomes. This does not mean motivation is useless, but it means you rely on it less. A good investing habit works even on busy weeks, stressful weeks, and forgetful weeks. For automation to last, it has to fit real life. The best setup usually starts with the account where your income already arrives, because that keeps the process simple and predictable. From there, the transfer can go straight into a retirement account or brokerage account on the same rhythm as your pay schedule. Just as important, the amount needs to be sustainable. If you start so aggressively that it strains rent, groceries, or other essentials, the habit will feel punishing instead of supportive. A smaller amount that survives is far better than an ambitious amount that quickly gets cancelled. Once the habit exists, the goal is to protect it and let it grow gradually. Keeping investment money separate from everyday spending reduces temptation and makes the contribution feel less available for casual use. It also helps to review the amount every 6 to 12 months, especially after a raise or a change in expenses. Many strong investing habits begin with modest numbers and grow slowly over time. That is not a weakness. It is usually a sign the system is realistic. The true strength of automation is not how dramatic the starting point looks, but how easily the behavior can be repeated. Consider a simple example. Maria takes home $4,200 per month and chooses to automate 10% or $420 into an index fund account. After 1 year, she has contributed just over $5,000, not because she made brilliant market calls, but because the process kept going. If she continues that pattern for 10 years and earns an average annual return around 7%, the account could grow to roughly $74,000. The exact return will vary, of course, but the lesson is clear. Regular contributions, sustained over time, can produce meaningful results without requiring constant decision-making. Automation is powerful, but it can still be weakened by a few common mistakes. One is starting with an amount that looks impressive, but puts too much pressure on monthly cash flow. Another is saving only after spending, which defeats the whole pay-yourself-first structure. Many people also interrupt contributions when markets fall, even though declines are exactly when consistency becomes most valuable. And if the transfer date does not match the timing of your income, the system can create stress or overdraft risk. Good automation is not just automatic. It is affordable, well-timed, and designed to survive normal life. A practical first step can be very small. Identify the source of income that arrives most reliably. Decide on one modest weekly or monthly amount, and choose a transfer date that lines up with payday. Then select the account where the money should go, whether that is savings, retirement, or a brokerage account. That is enough to create the basic system. You do not need the perfect amount to begin. You need a setup you can actually keep. One decision made today can remove dozens of future moments of hesitation. Saving can be automated, but portfolio oversight still needs a routine. This is where habit stacking helps. Instead of asking yourself to remember a new investing behavior from scratch, you attach it to something you already do consistently, like a Sunday planning session or a monthly calendar check. The existing habit becomes the cue, and the investing action follows more naturally. That matters because inconsistency is often the real problem, not lack of knowledge. When a review is linked to an established routine, you need less motivation and less memory to make it happen. A good review habit helps you avoid two unhelpful extremes. On one side is neglect, where you rarely look at the portfolio and let it drift far from your original plan. On the other side is over-monitoring, where constant checking invites stress and reactive decisions. Neither approach supports long-term discipline. A planned review creates a middle ground, enough attention to stay aligned, but not so much attention that every market move feels like a problem to solve. Investing works better when oversight is steady and intentional, rather than absent or obsessive. It is also important to be clear about what a portfolio review is actually for. The purpose is not to watch prices or judge whether the market had a good week. The purpose is to compare your current allocation with your target allocation. Because stocks, bonds, and other assets grow at different rates, the mix gradually shifts over time. That shift is called drift. A review helps you notice whether your portfolio still reflects the level of risk and balance you originally chose. For most long-term investors, this review does not need to happen often. Quarterly is usually enough. That means once every 3 months, you spend 10 or 15 minutes checking whether the portfolio still lines up with the plan. The key idea is to keep the session light, focused, and limited in purpose. You are observing, not trying to solve everything at once. When reviews stay brief and scheduled, they are less likely to turn into emotional reactions to short-term market noise. A strong habit stack begins with a dependable trigger. Choose something that already happens consistently in your life, such as paying monthly bills, doing a Sunday planning session, or reviewing your calendar at the end of each quarter. Then define exactly what the portfolio review includes, so there is no ambiguity. Finally, put the whole behavior into one simple sentence. Like after my Sunday calendar review at quarter end, I check my portfolio allocation. That sentence matters because it turns a vague intention into a repeatable script. The simpler the stack, the easier it is to follow under ordinary life pressure. During the review itself, clarity helps prevent drifting into impulse. Log into your main investing account, record your stock and bond percentages, and compare them to your target allocation. If the drift is small, you may simply note it and move on. If it exceeds a threshold you have chosen, such as 5 percentage points, write down that rebalancing may be needed later. The important boundary is this: do not trade during the review. Separating observation from action protects you from making quick decisions in the same emotional moment. Marco offers a useful example. He already has a weekly Sunday planning habit, so he uses that routine as his anchor. But he only performs the actual portfolio review at quarter end. His target is 70% stocks and 30% bonds. If he checks and finds the portfolio at 74% stocks, he simply notes the drift and does nothing. If it reaches 78% stocks, he schedules a separate rebalancing step for later. That structure keeps the process predictable, low stress, and less likely to turn into unnecessary trading. You can build your own review routine with just a few decisions. Pick one habit you already do reliably. Decide which quarterly review dates you will use, and write your habit stacking sentence in plain language. Put the next review date on your calendar right away, so the future version of you does not have to remember it. It also helps to have a notebook, spreadsheet, or Notes app ready for recording the same few numbers each time. Small preparation now removes friction later. And that is often what makes a routine actually stick. Most review habits break down because they become too complicated or too emotionally loaded. A weak trigger makes the routine easy to forget, and checking accounts too often pulls you toward reactive thinking. Some people also turn a quick allocation check into a full research session, which adds friction and raises the chance of impulsive trades. Another common mistake is changing the plan during what was supposed to be a simple review. The healthier pattern is straightforward. Use one reliable trigger, review quarterly, and keep the focus on whether the portfolio still matches the existing plan. Investing mistakes often happen in emotional moments, not calm ones. A sharp market drop can trigger fear, a rally can trigger excitement or fear of missing out, and dramatic headlines can create a false sense of urgency. In those moments, the brain starts looking for immediate relief, which often means doing something quickly. The problem is that fast action can pull you away from a sound long-term strategy. The goal is not to stop having feelings, because feelings are normal. The goal is to keep those feelings from running the decision. An emotional trigger is any situation that creates a strong feeling and pressure to act right away. That might be a large one-day market drop, a powerful rally, a crash prediction in the news, or even a friend talking about a winning investment. Different triggers create different feelings, such as fear, excitement, anxiety, or envy. But they all share one feature: they make immediate action feel necessary. Once you recognize that pattern, you can start separating the trigger itself from the decision you eventually make. That awareness is the beginning of self-control in investing. A useful replacement for emotional reaction is a routine action decided in advance. Instead of improvising under stress, you follow a short sequence you already chose when calm. That routine might be as simple as waiting a few minutes, reviewing your written plan, and checking your allocation before doing anything else. The pause gives your rational mind time to catch up with your emotional mind. In practice, that small gap can make a big difference. You shift from reacting to a feeling toward following a process. Building this kind of routine works best when you keep it small and specific. First, identify the situations that usually trigger emotional investing behavior for you. Then, choose just one trigger to focus on, rather than trying to redesign every behavior at once. Create one simple response that is easy to remember, even under stress. Finally, write it as an if-then rule, such as if markets fall sharply, then I review my plan before making changes. A clear rule is easier to follow than a vague intention to stay calm. Good routine actions are brief, concrete, and realistic when emotions are high. For example, you might take 3 slow breaths and wait 60 seconds before touching any trade button. You might close the investing app until the next day, read your written investment plan, or check asset allocation instead of staring at daily price moves. Another helpful step is to write down one reason your plan still makes sense. These actions are not dramatic, and that is exactly why they work. They reduce decision pressure by removing the need to figure out what to do in the middle of stress. Writing your routine as an if-then rule makes it much easier to use. If my account drops more than 5% in one day, then I review my plan before trading. If I feel pressure to buy after a rally, then I wait 24 hours. If a scary headline makes me want to sell, then I ask whether my goals have actually changed. These statements are simple, but they do something powerful. They create a ready-made response before emotions rise. In stressful moments, clear language is often more useful than good intentions. A routine does not always end with doing nothing. Sometimes, the correct routine action is a planned portfolio move, but only if that move comes from your investment rules rather than your emotions. For example, if your allocation has drifted from 60% stocks and 40% bonds to 70 and 30, your plan may call for rebalancing. In that case, the action is still disciplined because it follows a predefined rule. You are not reacting to fear. You are restoring the level of risk you intended to hold. The difference is not whether you act, but why you act. Imagine Maria waking up to see her stock fund down 8% overnight. Her first impulse is to sell immediately because the decline feels dangerous and urgent. But she has a prepared rule. If the account drops more than 5%, she closes the browser and walks away for 15 minutes. After that pause, she rereads her long-term plan before making any decision. The market may still feel uncomfortable, but her thinking is calmer. The routine does not guarantee a perfect emotional state, but it gives long-term judgment a chance to take over. David faces a different kind of trigger. He hears about a stock that has surged and feels the familiar pressure to buy before it goes even higher. His routine is not to decide in the heat of that excitement. Instead, he waits 24 hours and then reviews whether the purchase fits his asset allocation and risk tolerance. Often, that delay reveals that the urge was driven more by excitement than by strategy. The important lesson is that process matters more than the story of the moment. A disciplined investor does not have to chase every impressive result they hear about. To make this practical, choose one trigger from your own recent experience. Describe it clearly. Write one simple routine action you will take every time it appears. And keep that rule somewhere visible. A phone note, desk card, or printed plan can all work. It also helps to practice the rule when you are calm, so it feels familiar before stress arrives. You do not need a complete emotional control system all at once. One clear replacement rule is enough to start weakening a costly habit. Discipline in investing usually grows quietly. It is rarely built through one heroic decision, and much more often through repeated small acts of follow-through. Small actions feel manageable, which makes them easier to repeat without resistance. Each time you complete one, you build a little more trust in your ability to stay consistent. That self-trust matters because discipline is not just about rules. It is also about evidence from your own behavior. Over time, consistency becomes more durable than intensity. A small win is any investing action that is easy to complete, quick to repeat, and low in emotional friction. That could be transferring $10 or $25, reviewing your portfolio without trading, reading one short article about an investment concept, or updating a simple tracker. The point is not the financial size of the action, but how repeatable it is. If a task creates stress, debate, or avoidance, it may be too large for habit building. Small wins should feel almost ordinary. These small wins matter because completed actions create momentum. When you follow through once, the next action usually feels easier, not harder. Visible progress also encourages repetition, even if the progress is simply checking a box or seeing a record of steady contributions. Just as important, calm routines reduce the chance that every investing task becomes emotionally loaded. Over time, habit can weaken fear-based reactions because the behavior feels familiar. Small wins do not remove emotion, but they do make impulsive action less likely. A simple, small win system has 4 parts. First, choose one action that takes less than 5 minutes. Second, attach it to a trigger you already have, such as Friday morning coffee, or the moment after paying a recurring bill. Third, define success by whether you completed the action, not by what the market did afterward. Finally, record the win right away. That last step matters because tracking turns an isolated action into a visible pattern, and visible patterns are easier to repeat. Once you have chosen a small action, the goal is not to make it bigger immediately. The goal is to repeat it until it starts to feel normal. For many people, that takes 2 to 4 weeks of doing the same thing in the same way. Only after the behavior feels ordinary should you increase the amount or add another step. Gradual change is much more stable than trying to leap from 0 to perfect discipline. In habit building, consistency comes before intensity. Maya is a good example of how this works. Instead of trying to transform her whole financial life at once, she starts with a $10 automatic transfer every Tuesday. She links it to a bill pay routine she already follows, which means the trigger is built in. Each time the transfer happens, she records it with a simple note that says win. After enough repetitions, the action stops feeling like effort and starts feeling normal. From there, she gradually increases her contributions until she reaches $100 per month. These habits matter most when conditions are stressful. In a market drop, people without routines often feel they must rely on fresh willpower. And fresh willpower is unreliable under fear. A practiced habit reduces that burden because the next step is already decided. Scheduled contributions can keep going, even when headlines are unsettling. That continuity helps prevent reactive selling or the sudden urge to stop investing altogether. Small wins build discipline in calm periods, but their value shows up most clearly under pressure. One way to practice this is through a short 7-day sequence. During the week, alternate brief account reviews where you take no action with 2 very small transfers, maybe $5 to $20. Add 1 day where you learn a basic investing idea, like diversification or index funds, and write down a sentence about it. Then spend 1 day reflecting on why you invest and what resistance you felt during the week. This exercise is not about maximizing returns. It is about building familiarity, consistency, and emotional steadiness around the act of investing. Small win systems can lose their value when people overcomplicate them. A common mistake is starting with an action that feels too large, which creates immediate resistance. Another is checking portfolio value right after acting, as if the habit should instantly prove itself through results. Some people also skip recording the win, which removes the visible feedback that helps habits grow. And it is important to remember that habit building is not a complete investment strategy by itself. It supports a good plan, but it does not replace one. That is the proper role of small wins. They help you follow a diversified, long-term plan more consistently, but they are not the plan itself. If a habit starts creating anxiety, shrink it until it feels manageable again. If your goals, time horizon, or risk tolerance change, revisit the broader strategy rather than just adjusting the routine blindly. The aim is not to become perfect overnight. The aim is to make discipline a little easier each week, so your behavior stays aligned with your long-term intentions. Market timing often sounds smart because it promises a simple advantage: get out before declines and get back in before recoveries. But that idea depends on predicting short-term price moves accurately enough to improve results. In practice, timing usually means buying or selling based on headlines, recent market action, or a feeling about what comes next. It looks sensible in theory because everyone wants to avoid pain and capture opportunity. The difficulty is that short-term markets are noisy, fast-moving, and hard to forecast consistently. So what feels like strategy often becomes guesswork. Timing usually backfires because it requires two correct decisions, not one. You have to know when to get out, and then you have to know when to get back in. Markets also move for many overlapping reasons, including rates, earnings, economic data, sentiment, and news, all interacting at once. That complexity makes short-term predictions especially fragile. Even worse, missing just a few strong recovery days can significantly reduce long-term returns. Fear often pushes investors to sell after a fall, while excitement pulls them back in after a rally, which is exactly the wrong order. For many investors, timing is not really a careful strategy at all. It is a habit loop. A market drop triggers fear, a rally triggers urgency or fear of missing out, and dramatic headlines create pressure to act immediately. Emotion rises, and the impulse becomes buy, sell, or change something right now. That can happen even when a person sincerely believes in long-term investing. Recognizing market timing as a habit loop is useful because habit loops can be interrupted and replaced. The first step in breaking that cycle is identifying your personal triggers. Maybe it is a sudden market decline, a scary story about recession or inflation, a friend talking about fast gains, a sharp drop in your account balance, or an expert making bold short-term forecasts. Different people are vulnerable to different cues. When you can name the trigger, you create a little distance from it. Instead of being swept directly from emotion into action, you start to notice the pattern as it happens. Recognition is often the first crack in an automatic habit. Once you notice the urge, the immediate task is to pause. Do not trade in the same moment the feeling appears. Take 3 slow breaths, close the app, or physically step away from the screen. For any trade that was not already part of your written plan, wait until the next day. That pause may sound simple, but it creates space between the emotional jolt and the financial decision. In that space, urgency often weakens enough for judgment to return. After the pause, return to your written plan. Review your long-term goal, your target asset mix, and your normal contribution schedule. Remind yourself what your rules say about rising markets and falling markets, instead of inventing a new rule in the moment. A written plan acts like a steady reference point when emotions try to pull you off course. It turns the question from, "What do I feel like doing right now?" to "What did I already decide was sensible?" That shift is one of the strongest defenses against market timing. If you still feel the need to do something, replace prediction with a routine action that fits your plan. You might confirm that your automatic contribution is still on schedule. Increase it slightly if your budget allows, or add a small planned investment. If your allocation has drifted meaningfully, you might rebalance, but only because your rules call for it. You can also write down the concern and revisit it later instead of acting immediately. This approach gives you an outlet for action without turning that action into a guess about short-term prices. It keeps you engaged, but in a disciplined way. Think about Fatima reading a scary market headline and feeling the urge to sell. Her routine begins with 3 slow breaths, not a trade. Then she reviews her written investment rules, checks that her next automatic contribution is still scheduled, and decides to add a small extra investment that fits within her budget. Notice what she is not doing. She is not trying to call the bottom or outsmart the next headline. She is simply returning to plan-based behavior. That is how a routine can transform a panic moment into a disciplined one. An important part of weakening the timing habit happens after the emotional moment passes. Look back and ask, what actually happened after the trigger? Did the scary headline lead to lasting damage? Or did the market recover? Would acting on the urge have improved your outcome? Or would it have created regret? Did your plan protect you from a mistake? This kind of review builds personal evidence, and personal evidence is often more convincing than general advice. The more clearly you see that urgency was misleading, the weaker that habit becomes. To build your own interruption plan, start with one recent timing temptation. Name the trigger, note how you reacted, and record what happened afterward. Then write a replacement routine in plain language, such as, "If I see a scary market headline, then I will wait 24 hours, review my written plan, and follow my normal rules." Add a wait period before any unplanned trade, so the rule has real force. This does not require perfection. It just requires a clear script for the next time the pattern appears. What matters most is not your ability to predict short-term market moves. It is your ability to build habits that keep you steady, invested, and aligned with your goals. Headlines are not commands, and willpower alone is not a reliable investing system. You will probably slip sometimes, because everyone does. What matters is noticing the slip, learning from it, returning to the routine. Over time, calm, repeatable habits become far more dependable than forecasts.